All right, guys. So at this point, we put our clients on hold, right? We did the underwriting based off their health conditions and looking at the financial inventory, we wrote down the options. So the prior video, I explained what normal mortgage protection is and what equity protection is. So from here, I'm going to give you the example. So let's say we found out all the information. This guy is 38 and he just takes high blood pressure and nothing else, no other complications. I'm going to show normal mortgage protection in the form of 100%, 75%, and 50% of whatever his loan balance is. So this is how I would answer the phone after we, after the hold. So I'll say, hey, John, you still there? Sorry about that hold, but here we are. So go ahead and grab your pen and paper. So I'm actually going to pull up the script at this point. 1 second. You should see the script on here. We're going to scroll on down, and here it says options and policy features. So again, I take him off hold. I say, hey, John, you still there? He's like, yeah, perfect. So go ahead and grab that pen and paper. I'm just going to go over the options the state's recommending for you. And it says it right there on the script. And so, guys, if we're looking here, if someone's healthy, and it's very clear in a highlighted fashion, if healthy, you read that. If not healthy, you read that. So remember, if healthy, it's normal mortgage protection. If not healthy enough, it's going to be equity protection. So you're going to read one of those two things. And because this guy is healthy, this is what I'm going to read. Okay. So again, it's going to be, hey, so John, go ahead and grab your pen and paper. I'm just going to go over the options the state's recommending for you. He's going to say, perfect, I'm ready. So I say, hey, the way this works is that they give you 3 options. You could cover 100% of the mortgage, 75% of the mortgage, or 50% of the mortgage. Honestly, you may not need to cover the full 100% of the mortgage because in reality, you're actually going to continue to pay it down. But we're going to look at all the options available. So this coverage works a little bit different than general life insurance because life insurance is more like death insurance. Mortgage protection insurance is the type of insurance that's going to protect you while you're still living. Okay, so if you get sick, disabled, or can't work, this coverage will kick in to pay your mortgage, or you can access it if you do become terminally ill. So again, guys, I don't read those paragraphs really fast. I don't read them off like a runoff sentence. You pause, you show where the important parts are in that paragraph so they can really understand what you're saying. So after I read that, I then have John, I'm going to say, so I read that paragraph and I say, perfect. So John, on your piece of paper, I want you to write down option 1, option 2, and option 3. Okay. So from there, I'm going to read the script. It's going to say, now I'm going to go over the benefits with you of the plan. I just want you to understand that all 3 of these options have the same exact benefits. They're just different coverage amounts. Okay, so you're not going to write this on the options. Leave that blank. I want you to understand the benefits of this plan. All right, so we're going to go with, we'll pause really quick with the role play. I want you guys to know that he's, like we mentioned, 38-year-old male. He only takes high blood pressure and, non-smoker. Also, his loan balance is $300,000. He's paying $2,000 a month on his mortgage payments, and he has about $200,000 of equity. Those are just key things to know. And he has a 30-year term when he bought it. Okay, so those are the key things for this example. Now I'm going to go back into play here. And so I say, perfect. Now I'm going to go over the options with you of the plan. I just want you to understand that all 3 options have the same exact benefits, John. They're just different coverage amounts. Okay, so before you write down those options, let me go over these benefits. I want you to write down that this is a 30-year term. So it's going to match your mortgage term. All right. Next thing, I really want you to understand that this is portable. So go ahead and write that down, portable. I want you to know that this is not tied to your lender or your address. It's tied to you. So if you decide to up and leave the state or move out of the country, this coverage follows you and it doesn't expire just simply because you move out of the home. All right. It's locked in for those 30 years and it follows you. Next, I want you to write down locked in rate. This is super important because if you do get approved, John, the price never goes up and the coverage never goes down. All right. So again, these type of policies, they're really expensive. They get more expensive as you get older or if you become more sick. So if you do get locked in for today's age and health, which is technically the cheapest rate you can get it because we're the youngest we are today, you're going to get that locked in at that price. It'll never go up and the coverage will never go down. All right. And next thing, I want you to know that this is going to pay out on any death, natural or accident. All right. And next thing, this is the most important thing of this plan are the living benefits. So write down living benefits, John. This is going to cover you in the event of a chronic, critical, or terminal illness. All right, I'll define what a chronic illness is. A chronic illness is the loss of 2 out of the 6 activities of daily living. What that means is if for whatever reason you can't walk, bathe, talk, eat, medicate, and transfer, if you can't do 2 out of the 6 activities of daily living, that probably means you're not working. You would have access to this coverage. That's a chronic illness. A critical illness is any type of life-threatening cancer, stroke, heart attack, organ failure, kidney failure, ALS. You would have access to this coverage if you had any of those illnesses. And then lastly, a terminal illness. God forbid the doctor says you have less than 12 months to live. So if you have any of those, you would have access to this coverage. The living benefits is the most important part of the plan, okay? And then so obviously if you read that there, if you're doing CBO or ROP, so CBO is cashback option, ask your mentor or your manager, they'll explain to you what that is. Then you say that benefit if it is CBO. What we're gonna look at for this example is just a normal Americo term, it's gonna be 125, all right? So after I explain the benefits, I'm not going fast. I want him to say, yeah, I get it. Okay, cool. You know, every time I'm like, okay, I wait for him to say, okay. So I read off those benefit amounts. After that, I say, so basically, John, what this plan is going to do for you is if you get a major illness or a disability, it's going to make sure you get to keep the house, or if you outright pass away, it's going to make sure that your mom will get to remain in the home. Do you have any questions on how any of this works? Then I'm going to wait for him to say no. Most people, they might ask some questions, but you really want to track that they're following along what you're saying because they want to really understand the value of the product. And I tell people this, that life insurance is not a tangible sale. It's not something you could drive home with or eat or smell or touch. You have to really illustrate the benefits of the plan before you show them prices, because it's just going to show how important this is for them. So that's why I think it's very key to explain the benefits so they understand. Then you show the prices. You don't do it backwards because they're never going to buy. All right. So after he says, no, I don't have any questions, we're now going to explain and read the paragraph of presenting. So after he says, no, I don't have questions, I'm going to say, perfect. So John, we're going to go over the options now. But just so you know, the options I'm going to have you write down are not a guarantee because we actually have to get an official approval from the insurance company first. To be very honest, John, I don't care if this costs you $5 per month or $500 per month. The only thing I care about is that we're going to find an option that's going to fit comfortably within your budget, and it's going to give you the peace of mind you're looking for. So if I end up showing you something that's a little bit more than what you think you can afford, please tell me. And if that's the case, I'll be happy to go back to adjust to whatever's comfortable. Does that sound fair? Again, we wait for the affirmative yes. Okay, so when he says yes, that sounds fair, I say perfect. So go back to that option 1, option 2, and option 3. So John, I want you to write down under option 1, 100%, which is going to be the $300,000. Option 2 for 75% is going to be $225,000. And then for 50%, you're going to write down $150,000. All right. So for option 1, John, for your age and health, if you were to get approved for 100% of the mortgage to be paid off for your mom, that's only $133 per month. Option 2 for 75% of your mortgage to be paid off if you suddenly passed away or got sick, that's only going to be $102 per month. And then lastly, option 3 for 50% of your mortgage to be paid off for your age and health. And if you did get approved at that rate, that's only $71 per month. Okay. Now, like I said before, we can't commit to any of these today, but if the insurance company came back and said, hey, John, you're approved for the coverage, which one of these options make the most sense for your budget to leave behind to your mom so she doesn't risk, losing the home to the bank? Pause. And right there in bold red, it says silence until they pick. That's where people joke around. They say the first person to talk loses, right? So you're going to wait for them to look at these numbers and the value. They're going to pick the option. John is probably going to say, hey, option 2 is the best option. And then from there, you just casually say, cool. So option 2, the 75%. So $102 is comfortable for your budget, John, if you do get approved. And he's going to say yes. Okay. So then from there, I say, perfect. So go ahead and grab your driver's license. They're just going to do a check on you, make sure you're not a reckless driver, but that's not you, is it? And normally they laugh because it's kind of a joke. And then from there, you're going to process the application. And we could talk a little bit more about the next segment. But again, guys, the whole part of this I want you to understand is the benefits is the key feature, and the living benefits with normal mortgage protection. We might do a different segment when you explain equity protection. All right.